everyone. Okay, so let's continue on in chapter 2. So in chapter 2 so far, we've talked about the accounting cycle. We've talked about the different types of accounts and the relationship to the ledger, the general ledger. We've talked about debits and credits and explained their role in double entry accounting, as in every entry has to have equal debits and credits. So at least two things are happening. For example, if you sell something to somebody or sell a service to somebody, there's cash that you get and you record the revenue as in you provided a service to somebody. We talked about the chart of accounts and also its relationship to the ledger or to the general ledger. And the chart of accounts was the numbering system. And that's consistent. So in the book, it says that the assets are like the 100, the 101 to 199 range. So not all companies have a 3-digit chart of account or account number assigned to each account. Sometimes they might be, actually, I've seen them up to 10 digits long, but assets still always start with a 1. Liabilities still always start with the 2, and on, okay? All right, so now what we're going to do is we're going to analyze the impact of transactions on the accounts. So we talked a little bit about analyzing the accounts already, but we're going to talk about recording the transaction in the general journal and then posting it to the general ledger. And then once we're done that and we add up the balance in each of the ledgers or what we're going to call T accounts, once you get the ending balance, we're going to use those balances for all of our accounts to prepare what's called the trial balance. Okay, so as you can see here, step 1 is the analyzing. Step 2 is the recording, the journal entry. Step 3 is posting it to the general ledger from the general journal. And step 4 is creating the trial balance. Okay, so journal entry analysis. So a journal is a record where the journal entries are posted in chronological order, so by date, and it shows the transaction entered into the accounting information system. Okay, so the journal entry, so that's the whole journal. Okay, and this goes on and on and on and on for years. So you can go back through a company's books, so to speak, looking at their journal and see all of the journal entries that have been made over the years for the organization. And you can do that in a manual system, so it would be in a type of a book, or you can do it, even if it's a computerized system, you can go back through a company's journal and see all of the journal entries that have been recorded for over the years. So a journal entry is an individual transaction that has been entered into the journal. So the example I gave a minute ago is if you sell a service or provide a service to somebody and then they give you cash, okay? So that would be a journal entry. You'd have to record the revenue and you have to record that you received cash. Okay, so journalizing is the process of recording the transaction in the journal. So this picture's a bit confusing, but what it's showing you, if you follow the arrows, it's showing you that once you have posted the entry into the general journal, you can see here, this one here, the transaction that they're using is for Haley Walker and cash. So what that's saying is Haley Walker Capital is credited $10,000 and cash into the company is $10,000. So what's going on there is Haley Walker made an investment into her company of $10,000. So she took $10,000 of her personal money and gave it or invested it into the company. Excuse me. So the way that would be recorded is cash goes up or is debited 10,000 because cash is an asset and the normal direction of an asset is a debit, or to increase an asset is a debit. And then Haley Walker Capital is being credited because the normal direction for an investment or for the equity in a company to increase is to be credited. And we're pretty sure that this is going to be correct because our debits and our credits balance. You can also see where they have a date next to cash, so we know it happened on March 1st. And we also, under PR, have numbers associated with the accounts. So we've assigned 101 to cash, and we assigned 301 to Haley Walker Capital. And if you remember, assets start with a 1, liabilities start with a 2, our equity accounts start with a 3, so the capital and the withdraw account both start with a 3. 4 would be our revenues, and 5s and 6s are our expenses. So once you post this into the general journal, it then needs to be transferred over to the general ledger so that we can keep track of the balances in each of our accounts. So you can see here that the ledger for cash, you have account 101 on the top and next to the word cash. Then we have debited cash, $10,000, so therefore our balance is $10,000. Then we need to post the Haley Walker Capital. So we have the ledger Haley Walker Capital with account number 301. And then we post the 10,000. We know it's a credit because that's what our journal entry is showing. So we post it into the credit column. And then we've got a balance of $10,000 credit in that ledger. Okay. So accounting transactions in action, okay? So we went through it very, very slowly, showing you how to post the journal entry and then how to take that entry and post it into our general ledger. So again, if you want to go back and watch that again or pause it and make sure that you can follow where information is going, that may help you. Okay. So now what we're going to do is post an entry. So we've got more detail around what is happening in the entries. So recording a transaction. The following select transactions are recorded for Organico in the month of March. So we're showing 2 entries here. One that we just saw for cash is debited $10,000. Haley Walker is credited $10,000, the capital account. And that's because Haley Walker made an investment into her company from her own personal money. Okay, so another transaction that has happened is we're increasing supplies by $2,500 and we're decreasing cash by $2,500. We purchased store supplies for cash. And notice this is called supplies. Okay, so it's not supplies expense, it's supplies. So it's an asset. Okay, but as soon as we use those supplies, that's when they become an expense. But right now, let's say that they're sitting in a cabinet somewhere behind lock and key, and nobody can get to them, and that's why we know that they're still an asset, because they're still in the original condition, and if we needed to, we could actually return them. Okay, so we've got another transaction here where we bought supplies for $1,100. We charged it to accounts payable because we haven't paid for it yet. But we also bought equipment of $6,000, and we're putting it under a notes payable because we have special conditions where we don't have to pay it within 30 days. So that's why we know it can go under the account called notes payable. Okay, so it's like a loan from our supplier, and they're going to, oops, sorry, they're going to give us longer than 30 days to pay it off. Okay. So another transaction, again, this is from the original video last week, or from the journal entries last week. So we have on March 10th, we have a debit to cash of $2,200 and a credit to food services revenue for $2,200. So food truck sales that we made. So we sold items from our food truck, and that was up to $2,200 in revenue. Revenue is a credit because that's what increases our equity. And we know that cash is a debit, and it's increasing our cash. Two more transactions that we have. Rent expense is a debit, and cash. We know our cash is being reduced, so we're going to credit cash. Sometimes it's hard to remember when you're recording expenses, is it a debit or a credit? Sometimes it's easier to think about the other side. So for rent expense and cash, we know we're giving somebody cash. Or salary expenses and cash, we know we're giving somebody cash. So we know that our cash account is going down. And we know the way to reduce a cash or an asset account is to credit it, okay? And if you remember this as a rule, expenses are always debited, okay? In this course, you're never going to have to credit an expense. So if you can remember that, expenses always go up. We always have more expenses, unfortunately. So therefore, their expenses are always going to be increasing or debited, okay? And then to pay off an expense, we need to decrease our cash. Okay. So in this case here, we have a couple of different types of revenue. We have a food service revenue and a teaching revenue. Customer billed for services rendered. Okay, so again, revenue is just like expenses are always a debit, revenues are always a credit. And in this case, the customer hasn't paid us yet, so it's accounts receivable. We're due to receive that money in the near future or within the next 30 days. And we know that when we increase an asset, we need to debit it. Okay, so when we actually receive our cash from our customer that they owe us, we need to reduce the accounts receivable because they don't owe us that money anymore because they gave us the cash. So cash is being increased and accounts receivable is being decreased. And on the flip side of that, when we pay our supplier, accounts payable is being reduced, so we're debiting it, and our cash is being reduced because we're giving them cash. So the way to reduce a liability is to debit it because our accounts payable is a liability, and we need to reduce cash. So we're going to credit it. All right, I'm going to stop the video here.